Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Welcome. Let's talk about one of the biggest moves a successful business can make, expanding its operations within the country. It's an exciting time, but beneath the surface of new markets and growth lies a critical foundation, the tax structure. Getting this right can create significant financial advantages. But getting it wrong, well, that can be a very expensive lesson to learn. Today, we're going to conduct a detailed analysis of these crucial tax considerations.
So here's our roadmap for this discussion. We're going to start with the 4 fundamental questions you must ask before you do anything. Then, we'll dive deep into the 2 primary ways to structure an expansion. We'll stress test these structures with case studies, one where the venture fails and one where it succeeds, to see how they really perform. And finally, we'll bring it all together to help you think about choosing the optimal structure for your specific situation. Okay, so first things first. Before you spend a single dollar or draw up any grand plans, every expansion strategy must begin by answering 4 foundational tax questions. Think of these as your strategic cornerstones. Let's frame these in a practical way. Question 1, simply, what will the annual tax bill on our new profits look like? Question 2, new ventures often lose money at the start. How can we use those startup losses to our advantage, maybe to reduce taxes on our profitable core business? 3, the tough one. What are the tax consequences if this expansion doesn't work out and we have to shut it down? And finally, number 4, how do we efficiently get our initial investment and any future profits back to the parent company? Answering these 4 questions provides the analytical framework for everything that follows. So when you're expanding using your own company's existing resources, you generally face 2 primary structural choices. You can create a new division within your current corporation, or you can establish a completely separate new subsidiary corporation. Let's examine the trade-offs between these 2 paths. This really boils down to a classic business dilemma, prioritizing immediate cash flow versus ensuring legal protection. With a division, it's simply an extension of your existing company. The huge plus here is that any startup losses from the new venture can be immediately used to reduce the taxable income of your profitable parent company. That means instant tax savings, which helps cash flow. The massive drawback, unlimited liability. If the new division runs into trouble, your entire parent company's on the hook. On the other side, a separate corporation creates a legal firewall. If the new venture fails, the parent's assets are protected. That's a huge benefit. But the trade-off is that the new corporation's losses are trapped within that entity. You can't use them right away to offset the parent's profits. Theory is one thing, but let's put these structures to the test. To really understand the implications, we're going to run a stress test, a case study where the expansion, unfortunately, doesn't succeed. This will reveal the true after-tax cost of failure for each structure. So here's our scenario. Picture this. An existing profitable company operating at a 27% tax rate invests $100,000 in a new project. For 5 straight years, that new venture loses $30,000 annually. After racking up $150,000 in total losses, management decides to pull the plug. Let's run the numbers and see how this plays out. All right, let's trace the cash flows here. Under the division structure, notice the immediate benefit. That $30,000 loss each year generates a tax shield, giving the parent company an $8,100 cash saving every single year. But look closer. The total losses are $150,000, which is more than the $100,000 investment. Because of the unlimited liability, the parent company has to inject an extra $50,000 to cover those debts. Now shift your eyes to the corporation structure. No tax savings in years 1 through 4. The tax benefit is delayed until the very end, in year 5, when the parent company can claim a capital loss, resulting in a one-time tax saving of $13,500. The critical difference here is the timing and nature of these cash flows. Now, we can't just compare the net cash outflow. A dollar today is worth more than $1 5 years from now. That's the time value of money. So to make a proper comparison, we need to calculate the net present value, or NPV, of these outflows. Using a standard discount rate of 12%, the NPV of the cash outflows for the division structure is $102,600. That is the true economic cost of this failed venture in today's dollars. Now let's do the same for the corporate structure. Its NPV of outflows is $92,300. And this is the key insight. Even though the division structure provided tax savings every single year, the corporate structure ultimately proves to be the less costly failure. Why? Because that limited liability shield protected the parent company from having to inject that extra $50,000 to cover the excess losses. And this really gets to the heart of the matter. The decision isn't just about chasing immediate tax savings. It's a complex interplay between the timing of those savings, the potential for further investment, and the powerful, tangible value of legal protection. The concept of limited liability isn't just an abstract legal term. In this case, it had a direct, quantifiable, and positive financial impact. Okay, enough doom and gloom. What happens if the expansion is a smashing success? Let's flip the script and analyze a profit scenario. And to add a layer of real-world complexity, we'll imagine our company is expanding across provincial borders into a jurisdiction with a different tax rate. In our next case study, we have an established company in Alberta expanding into British Columbia. The new BC operation is projected to generate a tidy $30,000 profit. Now, the key variable here is the provincial tax rates. Alberta's is 12%, while BC's is slightly lower at 11%. Let's explore 3 different ways this could be structured. Method 1 is the simplest of all, direct sales. The Alberta company simply sells to customers in BC without setting up an office or a physical location. In tax terminology, they have not created a permanent establishment. Because of this, the taxation is straightforward. All of the company's profit, including the new $30,000, is taxed in its home province of Alberta at the 12% rate. The tax on that expansion profit is $3,600. Method 2 involves opening a branch office in BC. The moment you do this, you create that permanent establishment, which triggers a very particular set of tax rules. A provincial income allocation formula kicks in. Now, what's fascinating is that this formula doesn't care where the profit was actually earned. Instead, it allocates the company's total profit between the provinces based on the proportion of sales and salaries in each. In our example, the formula actually assigns $48,300 of profit to be taxed in BC. This may seem counterintuitive, but because more profit is now being taxed at BC's lower 11% rate, the total incremental tax on the expansion is only $3,117. And our third method is to create a whole new, separate BC corporation. From a tax perspective, this is very clean. The new BC company is its own distinct legal entity. Therefore, its $30,000 of profit is subject only to British Columbia's tax rate of 11%. The tax bill is a simple $3,300, and that complex allocation formula we just discussed doesn't apply at all. So let's look at the final results side by side. We have the same $30,000 of profit, but 3 different tax outcomes. The direct sales method was the most costly, with a tax bill of $3,600. The separate corporation was in the middle at $3,300. And the winner, rather surprisingly, was the branch location. Thanks to the nuances of that allocation formula, it yielded the lowest tax bill and the lowest effective tax rate of just 10%. It's a powerful demonstration of how profoundly structure can influence your tax liability. We've now examined both a failure scenario and a success scenario. It's time to synthesize these findings and identify the core decision variables you must weigh when choosing the right structure for your own business expansion. Ultimately, your decision comes down to a careful balancing of these 4 key factors. First, the classic trade-off between loss utilization and liability. Do you want the immediate cash flow from a division or the ironclad liability protection of a separate corporation? Second, provincial tax rates. Can you strategically use different provincial rates and those allocation formulas to your advantage? And finally, the nature of the income itself, as some types, like manufacturing profits, can have their own unique allocation rules. This brings us back to our 4th foundational question. What about getting the money back home? For a domestic expansion of this type, where you're not bringing in new outside investors, this is often a non-issue. In Canada, for instance, dividends can typically flow from a wholly owned subsidiary to its parent company tax-free. So when choosing between a division and a separate corporation, the ease of repatriating funds is generally not a differentiating factor. So after all this analysis, what's the single correct answer? The reality is, there isn't one. What our analysis reveals is a fundamental strategic tension. Are you prioritizing the limitation of potential liability, building a fortress around your core business, even if it means a higher after-tax cost of failure? Or are you focused on maximizing after-tax cash flow, accepting more risk for the sake of immediate financial efficiency? There is no one-size-fits-all solution. The optimal structure is the one that best aligns with your firm's unique tolerance for risk and its long-term strategic objectives.